If you're planning a self-build, you've probably wondered, what are lenders actually looking at when they assess my application? Why do some self-build mortgages sail through while others get delayed, reduced, or even declined? Well, it all comes down to risk. Self-build lending is assessed differently from standard residential mortgages because underwriters will assess whether your entire project is financially stable from start to finish, rather than just if you can afford a lump sum mortgage right now. So in this video, we're going to walk you through exactly what underwriters look at and how you can strengthen your application before it's even submitted. Let's start with a big picture. The 4 pillars of self-build assessment. When an underwriter looks at a self-build application, they're usually evaluating 4 core areas. 1. The borrower. 2. The deposit and liquidity position. 3. The project itself. 4. The costings and end value. If any one of these pillars is weak, the overall application feels riskier. If all 4 are strong, the project feels controlled and well managed. So let's break them down properly. Pillar 1, the borrower. In a standard mortgage, affordability is often the dominant factor. In self-build, affordability is still important, but resilience is just as critical. Underwriters will look at your income stability, employment type, length of employment or trading history, affordability calculations, existing financial commitments, credit history, and cash reserves. And they will use all this information to evaluate whether you can manage a complex financial project over 12 to 18 months or whatever your predicted timeline may be. For example, if you're self-employed with a stable income and low debt, that's straightforward. But if you're self-employed, they'll look more closely at the length of trading history, consistency of income, dividends versus retained profit, sustainability of business. Self-employment isn't a red flag, and at Mayflower Mortgage, we've helped lots of self-employed people obtain a self-build mortgage successfully. But for situations like this, there will often be more information that's required. They're also assessing liquidity. If your application shows strong income, low existing commitments, sensible monthly surplus, that builds confidence in your application. But if your affordability is tight before the build even begins, that increases the perceived risk. Pillar 2, deposit and liquidity position. Underwriters will be thinking about how much deposit you have and also what happens after the deposit is paid. If someone commits 25% deposit but leaves himself with no buffer, that's riskier than someone who puts down 20% but retains some strong reserves. So underwriters will assess the full picture, looking at your total contribution, remaining savings, contingency, and exposure to cost overruns. Pillar 3, the project. Underwriters look at the project as if they were investing in it themselves. This is the part where self-build finance differs the most from standard lending. They will assess things like plot location, planning status, build method, contractor involvement, complexity, access, and infrastructure. For example, a simple brick and block build in an established residential area feels straightforward, but a complex, modern, non-standard construction in a very rural location with limited comparable evidence requires deeper scrutiny. Non-standard construction methods aren't automatically declined. We work to get many complex cases through, but those that are less straightforward will require a strong application, including clear documentation, strong justification, and realistic valuation. If the design is ambitious but unsupported by local market evidence, they will question the end value, so make sure it's clear that it's to be a wise investment. Pillar 4, costings. This is one of the most important and most misunderstood areas. To put it simply, underwriters assess whether your build budget is realistic. They look at cost per square metre, contractor quotes, professional fees, groundwork allowances, contingency. One of the biggest red flags is undercosted builds. If a project appears significantly cheaper than industry norms, that raises concern. Underwriters will start to think about, has this borrower underestimated? Will they run out of money mid-build? Is contingency included? That is why structured, detailed costings are critical. At Mayflower, we provide a complimentary, fully costed schedule of works to all our customers that itemise the entire build. This shows underwriters that the numbers are thought through, nothing material has been overlooked, the project has been professionally structured. That alone can significantly strengthen confidence and increase your chances of approval. Pillar 5, the end value, or GDV. The end value can also be referred to as GDV, which means gross development value, and this projected end value is the final area underwriters will scrutinise. To do this, they will assess multiple areas of your projected end positioning, including comparable sales, market evidence, location desirability, specification level, local demand. Over-optimistic projected values are a common issue. If a borrower expects a £750,000 end value, but comparables support £680,000, then it's likely there will be questions on your application because loan-to-value ratios are calculated against that final value. If the valuation falls short later in the project, it can also affect final stage releases, so it's important to get this part right. Common red flags that trigger concern. Let's talk about some specific examples that often raise underwriter eyebrows. Some red flags we've seen include unrealistic low build cost per metre squared, no contingency included, minimal deposit expectation, over-reliance on credit cards or short-term borrowing, incomplete contractor quotes, complex self-managed bills without experience, aggressive end value assumptions, poor credit history with no explanation. None of these automatically result in a decline, but they do increase scrutiny, which in turn increases delays. So at Mayflower, we avoid all of these. It's best to go in with a really strong self-build application if you want to get it approved as soon as possible. So how do you strengthen your self-build application? 1. Present realistic, detailed costings. Avoid generic builder quotes and use structured documentation. This is where a fully costed schedule of works provides real value as its demonstrated discipline. 2. Include genuine contingency. Minimum of 10% contingency is recommended, but if you can aim for 15%, then even better. That contingency must be visible in the numbers so that your lenders are aware of your full positioning and it can be used to strengthen your credibility. 3. Demonstrate clear cash flow planning. Underwriters are reassured by transparency and detail. That's why we provide a personalised cash flow forecast for clients. This shows when stage funds are released, when payments are due, and where gaps may appear. The more you can demonstrate proactive financial planning, the more your perceived risk will be reduced. So typically, the more detail you can provide, the better. 4. Be conservative with end values. You'll want to support your projected value with evidence, so avoid aspirational numbers and be as realistic as possible. 5. Address any credit issues transparently. If there are historic credit issues, explain them clearly. It's best to raise these with an adequate explanation than stay silent and make it look like you have anything to hide. Especially if you have an expert in your corner, credit issues don't necessarily mean your application will be declined, but they will need to be addressed. 6. Show professional oversight. Anything you can do to make your application appear safer will help your approval. If you can demonstrate professional support, show a structured plan, and provide clear documentation, it will help underwriters see that your project is well thought out and manageable. It's always best to have a specialist in your corner, so you can book a free call with our expert team today to see how we can help.